want to welcome you all, and this is a fantastic audience. We never anticipated that we would have this many people. We usually get a good crowd, but have to bring in extra seats. That's something really nice. So I welcome you all to the annual fall forum of the State University Annuitants Association UIC chapter. Many of you are members of SUAA, I assume. Some of you have come not knowing exactly what it is, but we are the Annuitants Association. If you are an employee of the University of Illinois and are paying into the retirement system, you are an annuitant, and therefore you are both eligible and ought to be a member of the State University Annuitants Association. The SUAA works through its offices in Springfield and through its individual chapters to make sure that when you are retired, that when you do retire or you are retired, that you have the pension that was promised to you when you were hired and the health benefits that you were promised. And hopefully in the case of people who are on the Tier 2 pension system, that it will be improved over time so that by the time you do retire, it will be a meaningful and worthwhile pension. We operate by educating people, which is something we're doing today, and through other materials that we send out. We do it through advocacy, by being in Springfield and meeting with our representatives and senators, and engaging with people who are concerned about pensions. If you are not a member of SUAA, I would encourage you before you leave today to stop by that little desk where you signed in, get yourself an application form. It costs about as much as a cup of Starbucks every other week to be a member of SUAA, or a margarita once a month. So it's not a great pain. I want to recognize one person who is in the room, who is the executive director of SUAA, Linda Brookhart. And several of us, including Linda, of course, will be in Normal, Illinois tomorrow for the annual meeting statewide. Fall meeting. Sorry, the annual meeting comes in June. I knew that, but you sometimes slip when you're having fun. So today's forum has the title of Our Pensions, Changes, Choices, and Funding. Even though there is no longer a budget crisis in Illinois, at least for the moment, who knows what will happen tomorrow, but at least for the moment, we're having an election in approximately 1 week, and regardless of who gets elected, there will be action regarding pensions. You can just bet on it. Some of us were at a forum a week and a half ago, in which there were 3 state legislators. All of them said that there would be, they had to deal with pensions in the upcoming legislative session for next year. Besides that, there's a huge turnover in state representatives and senators this year. There will be many new people coming to the state legislature, and they need to be educated. And they will certainly have their own agendas. So we have 3 speakers today to talk about various aspects about pensions in general, and pensions in particular regarding University of Illinois. Our lead speaker this morning is Jeffrey Brown. He is the Joseph and Margaret Lackanosh Professor of Business, and I probably really messed that up, Professor of Business and the Dean of the Geese College of Business at the University of Illinois, Urbana-Champaign. He's a professor of finance and was the founding director of the Center for Business and Public Policy there. He's also director of the Retirement Research Center at the National Bureau of Economic Research in Cambridge, Massachusetts. Previously, Dr. Brown has served as a senior economist with the White House Council of Economic Advisors. He holds a PhD in economics from MIT, a Master of Public Policy from Harvard, and a Bachelor of Arts from Miami University of Ohio. The second speaker this morning, who should be familiar to many of you, is Lee Bridges. Lee Bridges has 27 years of work with SURS, the State University Retirement System. He does counseling and group presentations is the main focus of his job. He's here actually on campus the second Wednesday and Thursday of each month, and so I'm sure some of you have availed that opportunity. I can only say that about 17 years ago, my wife and I were returning from a Fulbright fellowship that I had in England, and we said, we need to think about where our pensions are these days, and retirement will be coming up in a while, so we should check it out. And we met with Lee and got really, really good advice. And so that's my recommendation of Lee Bridges as an expert. He knows his stuff. Our third speaker this morning is John Prochaska. He's retired, but formerly was credentialed as a CPA, fraud examiner, internal auditor, and governmental finance manager. He was the director of the university audits at UIC here for 17 years, and for 14 years was the administrator and CFO of the Hecton Institute associated with Cook County Hospital. He's been an adjunct faculty member at Roosevelt University, Northeastern Illinois University, and National Louis University. He has an MBA from Northern Illinois University, and he's been doing informal retirement education for nonprofit and governmental staff employees for nearly 20 years. I will be stepping off the stage momentarily and turning the moderating responsibilities over to our very capable SUA UIC President, Brenda Russell. And with that, I think we're ready to begin the formal presentations, and we will leave plenty of time for your questions and discussion afterwards. Thank you.
So I'm not sure if Bill Peterman told you his name. That's Bill Peterman. He's on our board. He's the second vice president. He's also on the state committee where he's one of the people involved in legislative action, so he's very well informed. Two things, and I'm not sure if he said this, but I'll say it again. Please turn off your cell phone. One other comment I have, we were asked for a sign language or interpreter, and I'm not sure if that person got connected to the person with the laptop, and since that person would be deaf, I don't know how to convey that information. You're good? They're good. See, you're good. I got that one. Thank you for being here. We're going to go ahead with the three speakers, and at some point we're going to pass around these 3x5 cards, probably begin whenever people feel like is a good time. So you can write down your questions, and we'll hold all the questions at the end. So with that, you're first.
Well, good morning, everyone. And first, let me thank you for having me here today. It's actually a bit of a treat. I became dean about 3.5 years ago, and since I became dean, I don't have nearly as much time to engage in my research and policy work on public pensions, which is what I did for 15 or 20 years before that. So it's always nice when I have the opportunity to pretend that I'm still an active professor and researcher up here. All kidding aside, it's actually really wonderful to be here. This is an important issue. I was telling somebody outside that back when I was in graduate school in the 1990s, I didn't quite realize what tremendous job security there would be in becoming an expert on pension underfunding. But given that it's a problem we don't seem to be able to solve here or in many states, it's certainly something I'm pretty confident that someday when I'm done being dean that the problems will still be there and I can go back to researching them. I wanted to really start today by making two observations that I think together kind of encapsulate the problem that we face. Because both of these statements are true. But if you only pay attention to one of the two statements, it will lead you down a particular path about what you think we ought to do. And yet, because both statements are true, therein lies the difficulty. So statement number one is that participants in SURS have earned their benefit. When they came to work for the university, they were promised a particular pension benefit and formula. That benefit was constitutionally protected. Many of them exited or never entered into the Social Security system, and therefore the SURS system is providing benefits to not only replace Social Security, but also a private sector retirement plan, and that explains the level of generosity in the plan. And it's certainly not the fault of any of the participants in the system that the state failed to fund. Okay, so that's absolutely all true. It is also true that the state of Illinois faces a deep fiscal hole that it is hard to get out of if we don't figure out a way to deal with the pensions, which are not the only, but are an important contributor to the state's fiscal woes. It's also true that hidden away in the details of how the SURS pensions are calculated, there are a number of provisions that I think are probably not as well designed as they ought to be, allow people to historically to have been able to maybe game the system a little bit and so forth. And one could also say that it's a little bit odd that we're giving 3% raises every year to retirees while the workers in the system are often getting 0% or 1% or 2% raises, and while many of our social programs in the state are being cut back and underfunded. Frankly, I think these are both perfectly legitimate views. They both have the virtue of being true. And the difficulty is that regardless of how we got here, and I'll talk a little bit about that, pointing fingers at politicians from decades past doesn't solve the problem. But since we all like to point fingers, let me just acknowledge who is to blame? Well, the first approximation, it is decades worth of members of the legislature and decades worth of governors from both parties who failed to adequately fund the state pension systems. Now, this is not a new problem. I was doing some reading a couple of years ago when I was writing actively in this space, and I ran across a 1948 state pension report. Now, the state pension system looked very different back then. It was a lot of local plans and so forth. But I'll tell you, if you read the report today and just added a lot of zeros after all the numbers, it was essentially you could write the same report today. We weren't funding pensions properly. It was going to catch up with us one of these days. We were putting too great of a fiscal burden on future generations and so forth. All the same things we could say today. Now, by the way, there's two ways to interpret that. One is, oh my God, we've been doing this forever, and how are we ever going to get out of it? And the other is, well, people were saying that we were going to have to pay the piper 60, 70 years ago, and somehow we muddled through it. And so maybe there's hope that we'll muddle through this one as well. But again, what's more important to me is not so much the focus on how we got here, but given that we are faced with I would say a multi-$100 billion pension funding hole, not just for SURS, but for all of the state systems. And I'm going to say multi-hundreds of billions because I don't think that government accounting standards do the calculations properly, and therefore the hole is bigger than what is often reported. And that's a significant drain on the financial capacity of the state. Now, having said that, I also want to say there's nothing particularly magical that says we have to be at 100% funding under the standard government, or under the government accounting standards that are used. For one thing, the government accounting standards, as I said, are not what any financial economist would say is the right way to measure the fiscal hole. The problem is actually bigger than it is. So what's the point of hitting a metric that is not even sufficient if what you want to have is full funding? But going the other direction, when you have an underfunded system, it's not like everyone's going to retire tomorrow and demand a lump sum on day one. So what really matters at some level is our projection of how much annual fiscal pressure this is going to put on the state to be able to pay the benefits when they come due, right? Think about Social Security, which is also underfunded, by the way. Social Security was never designed to be funded. It's basically a pay-as-you-go system, and as long as the taxpayers are paying in enough money to pay out the benefits to the retirees, you can run that system forever. The problem with Social Security is we've had demographic changes, people are living longer, people are having fewer kids, and so it has turned out not to be sustainable. Well, we're actually, CSRS is better funded than Social Security is. May only be 40% or 45% according to the official numbers, but that's a lot more than Social Security. So again, there's nothing magical about 100%, except that if you're not fully funded, then essentially what you've decided, you as in we as in the state of Illinois, is that we're okay making these intergenerational transfers, that we're okay essentially pushing the burden on to future generations to pay for what our generations failed to pay, okay? Now, what do we do about the fact that we're in this situation where we are underfunded? If you look at the projections of the kind of contributions that the state is going to need to make in order to just fund the normal cost of pensions, let alone pay down the liability, they are growing relatively rapidly, and they're growing relative to state budget, relative to revenue, and so forth. So it's a real fiscal problem. Well, unfortunately, we don't have a lot of good options, all right? We have, and it's good for everyone in this room, myself included, from a self-interest standpoint, but it's not necessarily good for the state, that we have the non-impairment clause of the state constitution that basically says, once you are in the system, your benefits cannot be diminished or impaired. Now, prior to Senate Bill 1 and the court cases that ultimately threw it out, I used to believe there was plenty of wiggle room in that non-impairment clause to basically say, look, any benefit that you've already earned, so if you're retired, that's everything, or if you're in the system like me, it's any benefits that you've earned up to that date, sure, we ought to protect those. To me, that just seems like an ethical and fair thing to do. But I didn't think that the courts were going to determine, which they in fact did, that once you're in the system, we can't even change the formula for how quickly your benefits accrue going forward. So in other words, if you're a 22-year-old who's starting work at the University of Illinois today, it would be considered an impairment if we said that 10 years from now, we're going to reduce the rate of accrual of your benefits. And the Supreme Court of Illinois essentially interpreted the non-impairment clauses to say you can't do that, all right? So what that has done is you've got a problem where you've got a mismatch between revenue and expenditures, and the state Supreme Court interpreted the non-impairment clause to say you can't do anything on the expenditure side. Now, there's been a few creative exceptions to that, and you're going to hear about some of these lump sum opportunities and all that, but I'll tell you, if there's money being saved there, it's usually because someone is getting hurt, all right? And I'm happy to explain what I mean by that in more detail as we go. So given that, one option is to amend the Constitution. Not necessarily to say that we can just willy-nilly do anything we want to pensions. I don't think we need to go as far as the state of Indiana, where the courts have ruled that pensions are mere gratuities, that's their wording, that can be adjusted at any time. But I do think there's a completely reasonable change that, if I could wave my magic wand, we would consider, which is to say, let's protect all the benefits you've earned as of the date of any pension reform. But going forward, we have the ability to make adjustments as the fiscal environment requires and as the competitive environment and labor markets require. We don't currently have that flexibility. Do I think that's likely? No, I don't. I really don't think it's all that likely that we're going to be able to pass an amendment to do that. The second approach you will sometimes hear talked about is this idea of consideration. And here's the basic idea. You've got a right to these pensions. So if we want you to give something up from your pension, then we have to give you something of value in return. All right? And there have been some proposals that have suggested a way of doing that. To first approximation, though, I have to say that if you've got something of value, you're probably not going to be willing to give it up unless you get something of equal value. So it's hard to know how you actually save money by doing that, right? And if I were being paid to represent the annuitants, which I'm not, my position would be, I have a constitutionally protected benefit. So if you want to give me something in return for giving up that benefit, I'm going to demand the full actuarial value of the thing I'm giving up. Else, why else would I do it, right? So you know, there's smarter people out there than me who understand how the legislature works and how the negotiations with the unions work and so forth, and maybe there's a way forward there. But it's not going to be something that's easy, and it's not going to be something that's going to sort of fill the entire funding gap. Third thing we can do is we can increase taxes. And there are two particular forms of this I want to mention. One is we can specifically begin taxing retirement income in the state of Illinois. So not just CSRS, but any retirement income, 401ks, et cetera. We're so there are some states that don't have an income tax at all. Most states that have an income tax retirement income. Doesn't mean they necessarily tax it at the same rate. It doesn't mean they might not have a phase-in schedule where they only tax amount above a certain amount and so forth. But we're somewhat unique. We're one of about a handful of states, I believe, that completely exempt retirement income from taxation. Now, why do I think this might work, although the legislature has shown absolutely no appetite for it, is we can't change your benefits, but you could argue that if we tax your benefit, to an economist I say that's the same thing. The difference is that because it's tax policy rather than retirement policy, it might not be considered to violate the Constitution. That's number one. And number two is it actually allows you to do it in a more progressive manner in the sense that you could say, well, look, we'll exempt the first $30,000, I'm just making that number up, of retirement income and only levy the tax on what's above it. Now, is that going to solve the whole problem? Of course not. But there is about $2 billion, well, somewhere between $1.5 and $2 billion a year in what we call a tax expenditure in the state, which is if you just applied today's tax rate to the amount of retirement income received by Illinois residents and Illinois taxpayers, that's the kind of revenue that you would generate. Now, you do have to worry about issues. Is this going to make all the snowbirds that spend their winters in Florida now spend 6 months and a day in Florida so they can escape the tax and so forth? But most of the empirical estimates suggest that that's not going to be huge. So that's something you could do. More generally, we could just say, look, we don't have a way to reduce benefits. We haven't paid our bills in the past, and now it's time to pay up, and we're just going to have to increase income taxes in Illinois. I don't want to get into a political debate over this other than to just simply point out, yeah, you can do that. But one at least has to recognize the fact that, at least currently, income taxes and corporate taxes are linked. We don't have the ability to do currently a progressive income tax, again, without a constitutional amendment. So you're talking about essentially raising taxes on everyone, individuals as well as companies. And when we're in a situation where we're trying to revitalize the state economy, that's not going to be helpful. We may have no choice, and it may be what we just need to do. But again, it's not necessarily a simple and an easy answer. So I wish I had an easy solution for you. But as I tell my colleagues all the time, not all problems have solutions, and they certainly don't all have easy solutions. At the end of the day, if I could kind of wave some magic pixie dust, I would actually have us revisit the generosity of the pension system. I would have us revisit the automatic 3% automatic annual increase, particularly in a low inflation environment. I would have us generate new revenue through both of the ways that I mentioned and have that flow into the pension system in order to start bringing our funding levels up. I'm not a political prognosticator. I don't know if any of those things are particularly realistic, but I, for one, am at least heartened that given the prediction that it's going to be on the agenda, because I think it needs to be. And it needs to be not only to provide some sense of certainty to everybody in the room who's currently presumably here in part because you're worried about your own retirement benefit, but also to reduce some of this burden on future generations. So I'm going to stop there, but I'll be delighted to take questions when the time comes. Thanks.
There are a couple more seats in the front if you're brave enough to come and sit in the very front row.
Well, good morning, everyone. It's kind of tough to go after the guy with the PhD from MIT, right, and Harvard. My name is Lee Bridges. I am also very happy to be here. I've been with the state universities for 27 years. There are always rumors floating around about my demise or my retirement or pending retirement. Just keep in mind that we will all retire one day, some sooner, others later. And when I do, there'll be someone who takes my chair and does a good, great, or adequate job, and probably not with my wonderful personality, but you know, you'll get over that. The first thing I want to touch on is the fact that each of us, by virtue of our employment at the university, have voluntary plans in regards to retirement. There's a 403B, or tax-sheltered annuity, which basically is Fidelity and TIA-CREF. There are additional options, what are called 457 plans, deferred compensation. Each of us can put away significant portions of our income toward our future. Now, you can use the term retirement. Some people say annuitize. I tend to say I'm getting paid not to work. That's the way I approach it. And I can go do something else. Maybe it's gainful, maybe it's not, but I have the option of doing something else somewhere else. But my CSRS pension is not going to be enough. So we always have to put away as much as we can elsewhere. Again, general information, you can put away between $18,000 and $24,000, $24,500 per year in these optional plans. Yes, you will miss it, but you will appreciate it sometime down the road. And that's with each plan. So minimum $36,000 if you're under age 50, almost $50,000 if you are over age 50. So it's a great opportunity for you to put away portions of assets. If you are one of those, and I always suggest for active employees who are 12-month employees, try to squirrel away as much vacation as you can. It is a payable benefit. The challenge for your department is that they typically don't budget for it, so you may have some pressure to use it, but from a pension perspective and from a law perspective, they can't obligate you to utilize it, to use it. My suggestion is to hold on to it, be paid out for it. The prudent thing would be to try to put it away in one of those 403B or 457 plans to save it for a rainy day. But you can also do something imprudent with it. Buy something silly, you know, or that will maybe last or not. But the bottom line is to have that money there available for you at the time you leave, just so that it is, you know, an asset that you can do something with. All right, so when the budget passed this year, there were 3 provisions that are kind of new and exciting. And as Dr. Brown said, may or may not be in your best interest to utilize, but they will be available for you. So the 2 are buyout provisions, and that's what you'll hear on campus. People will talk about these new buyouts. Technically at SURS, we will say accelerated pension payment options, or buyout. So for those who are, and this won't affect probably anyone in the room, inactive employees. Typically, if you're inactive, you've left the system. If you've met the vesting requirements, you're entitled to a monthly payment. But the state, as Dr. Brown mentioned, probably doesn't want to pay you for your lifetime with those appropriate increases. So what they're doing is incentivizing you to say, hey, what are my options? Can I take a lump sum? And the lump sum available will be basically about 60% of the actuarial value of what's in the account. Well, I'm sorry, 60% of the actuarial value of the annuity payable. So you'll see 2 things. There's an account balance, and there's what we call a separation refund or a lump sum refund that's available to you. What SURS will provide you upon request, sometime probably after January, but I think probably later than that. All of our retirement systems are to implement these plans. Optimistically, everyone said, oh, January 1 sounds like a great date. I've talked to our IT people and they say, oh, January doesn't feel like such a great date. So sometime after January 1st, you'll receive information about this. If you contact our office, we'll be able to provide you the actual amount payable with this lump sum payout, the accelerated pension payment option. And again, basically it is, to step back, there is the account balance, what's in the account, what you can actually take out of the account. At this point is a little less than what is in the account because there's a penalty. Retirement systems really don't, well, before this legislation, retirement systems really didn't like for you to take lump sums, but with this legislation, the state of Illinois is saying, okay, maybe we'd like you to take a lump sum. So there'll be this enhanced payment, and you'll just basically have to evaluate, should I take a lump sum or should I take a monthly payment? And with the lump sum, you're basically washing your hands of any attending benefits like health insurance, life insurance. So it's a significant part of your retirement decision-making process. And this is a significant portion of assets. Even if it's a small monthly payment, it is for your lifetime. There is the appropriate 3% compounded increase, and there is the health insurance option that's available to you. In addition, for those who qualify for the health insurance, but let's say you're working elsewhere, you move on to employment that is gainful and does provide health insurance as an option, and you're not Medicare eligible, which is age 65. If you don't need the health insurance, there is an incentive that the state currently offers. For those who have less than 15 or less than 20 years of service, the state will basically pay you $150 per month not to utilize the health insurance option. It is a opt-out incentive for health insurance participation. If you have in excess of 20 years of service, the state will pay you $500 per month not to participate in the state of Illinois health insurance program. Now, you're not opting out forever. You're just saying for this plan year, I don't need the health insurance coverage. Now, I have suitable coverage that meets standards elsewhere, either through a spouse or other job, and I want the money. And at the end of the next year, the plan year is July to June. The enrollment period is the month of May. You can re-enroll in the plan. There are no additional penalties or no costs over and above what anyone else would pay for that coverage. The second option or buyout that is available is tied to that 3% increase. So the Tier 1 increase, as everyone knows, is an automatic annual increase that's payable January 1st after retirement. It is a compounded increase payable for your lifetime. If you are providing a survivor benefit or a spousal benefit or a contingent annuitant benefit, you pass away, that person receives a portion of your pension for their lifetime with 3% compounded increases. So that's the standard. The option that each of us will have in the portable and traditional plans, beginning sometime after January, is that when you submit your application for retirement, you'll receive information about the pension, and you'll receive this option that allows you to elect to receive a benefit payable beginning the January 1st after you reach age 67. So it's tied to the Tier 2 provisions. So the increases don't begin until January 1st after age 67. They are 1.5%. They are not compounded. And the reason you may want to consider that option is that we will give you a pot of money. Now, the pot of money is based upon the effective date of retirement and 70% of the actuarial value of the difference in those two automatic increase calculations. Now, what I'll say, given that there's a video camera, is that anytime anyone offers you a pot of money, consider your options thoroughly. All right, third option is in regards to the increases that we receive as employees. Now, many of us are part of, excluding myself, a part of collectively bargained agreements. And if you are a part of a collective bargained agreement, for the short term, this doesn't affect you. But for everyone else, typically, well, sometimes we receive increases and sometimes we don't. If you receive an increase that is equal, well, that is in excess of 3%, so let's say you negotiate with your boss, or actually your boss is feeling good and they provide an increase that is in excess of 3%, there's no impact that will be felt by you, the retiree, at the time you retire. However, CSURS will calculate your pension. They will perform two calculations. One is our normal calculation. We will pay you your monthly benefit as the earnings are reported. We will do a second calculation based on if your increases were limited to 3%. And the actuarial value of the difference in those two amounts is basically sent as a bill to your employer. So if I negotiate increases that are greater than 3%, eventually my employer will receive a bill that says, hey, you paid more than 3%. There's an obligation, an actuarial obligation. You have to pay that. It's basically a penalty. In short, or kind of layman's terms, we probably won't be receiving increases that are in excess of 3%. I do appreciate everyone's attention. I'll be available to answer questions as the panel. And again, thank you.
Thank you, Lee. Now, John Prohaska, you wanted to use the flip chart.
I'll start here.
Okay, and it's going to be hard in this room for people to see.
I'm not here as your financial advisor. I'm doing an educational session, and hopefully you will learn some things. Now, most of the things that I'm going to speak on today really probably have more impact on your spouse than you. For those of you who have been in the system for 25 or 30 years, Social Security is not going to have much of an impact. Now, let me ask a quick question. Is there anyone in the room who is over the age of 70 and has not yet filed for Social Security? Okay, there's no more bonus for holding off. Now, Social Security has 2,826 rules and thousands of interpretations and exceptions to the exceptions. If you go to a Social Security office, or your spouse goes, technically, Social Security employees are not supposed to give advice. Based on some work that was done by the General Accounting Office of the federal government, about 1/3 of the advice that they give you, if you get advice, is either incorrect or it fails to help you maximize your total benefits. Now, for those of you who have money in a 403B, like TIAA, this current tax year, you're going to get a discount on your taxes. And if you are thinking about converting some of your 403B money to a Roth IRA, this is the lowest rate that you're going to get. And given what may transpire in the next two elections, that 22% rate is probably going to disappear rather shortly. The downside of making a Roth conversion is you've got to pay the taxes on it. But let's say you move $20,000 from your TIAA account into a Roth. You can actually do it within TIAA, but under the old standard, you had to pay $5,000. Under the new standards, you only have to pay $4,400. The downside is you can no longer recharacterize. Previously, if you had made a conversion to a Roth account, and then let's say the value of that stock went down, you could say, oops, I want to do over. Put the money back in my taxable account, and I'll file for a refund on the taxes that I've paid. You're no longer going to be able to do that. Okay, now Social Security has been around for 83 years. It essentially is renewed every year. It is not a permanent system. So if a radical group took over Congress, they could conceivably end Social Security. That's just something to have in the back of your head. Now, the way you get Social Security is by earning quarters of coverage. The rules changed back in 1978. You used to have to earn $200 in each calendar year quarter to get a quarter's coverage. Now it's done on a bulk basis, and if you earn just over $5,000 in a year, you can earn 4 quarters of coverage. And of course, to get your Medicaid, your Medicare Part A, you need to have those 10 years, 4 quarters for 10 years. Also, that's the minimum you need to be able to collect Social Security. There still is a $255 death benefit, but you have to apply for it. You have to apply for Social Security. Now, a couple of technical terms, and then I'm going to go to some examples. One of the things that Social Security does is they increment by a multiplier your earnings and come up with an adjusted amount. And that's called the Average Indexed Monthly Earnings, called AMI. And so if you have employment back from 1978, they probably multiply that amount by a factor of 5.5 or 6 to bring it up to current standards. They then take in all of those years, total them up, the best 35 of them, and they come up with what's called a primary insurance amount for your full retirement age. Now, currently the full retirement age is 66, and it'll be moving to 67. For many years, it was 65. At this point, I think I'm going to go to my charts, but a couple of the changes that have been made. You used to be able to do something called file and suspend. And what that was is, this is for assuming a couple both were covered under Social Security. You file for Social Security and say, oh, suspend it. But then your spouse can get a spousal benefit off that amount. You can no longer do that. Also, it's possible to suspend your benefit and have it restarted. Used to be that way. The law has now been changed, and once you suspend over the full retirement age of 66, you can't restart it till you're 70. Also, if you suspend any benefits that are being paid to other people, spousal benefits, perhaps you're a grandparent caring for a grandchild, all of those also disappear when you suspend your receipt of Social Security benefits. I'm going to need some help in a moment because not everybody's going to be able to see my little charts here. So if I can get a volunteer eventually to post them on the wall over there for the other half of the audience.
And while we have a short change of location, can someone start, maybe Larry, and pass the cards around for questions? Hopefully you have pens. We had free pens outside too. Thank you. There are more cards outside.
Okay, this is a basic Social Security calculation. And unless you spent the bulk of your time outside of the SERS system or a state system, this is what would apply to you. So if your spouse is a nursing supervisor over at Rush and had an average indexed monthly earnings equal to $75,000 a year, roughly currently, that would give her or him an AMI of $6,250. Now, Social Security is a social insurance system. So on the first $816, and this data is from the year 2014, the Social Security system uses the year that you became age 62 to determine what they call the bend points. So you get 90% of the first $816 out of the $6,250. You get 32% on the difference between the cap of 4917 and the 816 that you've already gotten, and you get 15% on anything over 4,917. Now, there is a maximum amount that you can earn under Social Security. You know, there's a cutoff point. Last year, it was $128,000, I believe. Okay, so you total those three pieces up, and that gives your benefit at your full retirement age. If you want to maximize your Social Security, you wait till you're age 70 to collect it, and you get an increase of 32%. So this benefit of $22.46 comes up to $29.65. And I'll need a helper here. Now, what happens if you don't have 35 years? Because that's what it requires. And I did this example based on my wife. Unfortunately, she wasn't making $75,000 a year, but she had 22 years of substantial earnings. Okay? So that reduced her benefit that if she had worked for 35 years that she would have gotten from $62.50 to $39.28. So we take, again, 90% of the $816, $734, 32% of the difference, taking out the first tier, and since she's under, her total is under 4917, she gets 0 at the 15%. These, Social Security calls these bend points. And so her Social Security, had she been making that kind of money, times the extra 32%, so there's an increase there. Then we have the windfall elimination process. For those of you who have worked less than 20 years under Social Security, okay, how many people have worked at least 20 years under Social Security? Okay, so we do have a few people. Okay, if you haven't worked, we take the same, your same PIA, and you only get, because if you have less than 20 years, you only get 40%, 90%. And that's the, in a sense, the social part of it. The presumption is that you had other earnings, and so the benefit that you would get is somewhat smaller. Now, if you work at least 30 years with substantial earnings, and I'm one of those people, I had exactly 30 years in when I had a major heart problem and wound up retiring. So I didn't have this reduction. I got, that reduction is worth about $500 a month. Someone would take that over. Thank you. Okay, the government pension offset. When you file for spousal benefits, and that, I'm assuming most everybody in the room may be able to try to do that. I did that and found out that my SURS pension was too much. So you get half of your spouse's primary insurance amount, and that's the primary insurance amount, not the amount that's been incremented by 32%. And let's say that my SURS monthly pension was $41.67, which is the equivalent of $50,000 a year. You have to offset 2/3 of your SURS pension, and you wind up, I got a letter back from SURS saying you're going to get 0 based on your wife's benefit. Now, if she had had a much larger benefit, I might have gotten something. but then eventually I waited till I was 70. Okay, so how do you make up the difference? I had some money in 403B. Every month I would take out about $2,000. Had to pay taxes on it. Wanted to get up to age 70. The reason I did that, and this is a very personal matter, in SURS, the default value for a spousal pension, that is a survivor, an individual and a survivor, is 50%. You can also do it at 75%, and you can also do it at 100%. But in each case, that reduces your monthly payment. So having had two daughters, both in college at the same time, and we needed the money, and I was no longer at the university, I took my pension at age 55, which meant that I had a 30% reduction in my pension. So to make up for that, I wanted to make sure that I would stick around to get her a full spousal benefit, particularly given all the heart surgeries and medicines I've been on. I'll just make a comment about that $500 offset. I'm on an anti-AFib medication. I pay $60 a month for it. If I went in to pay cash for it, it would be $830 a month. I'm also on a beta blocker, on a high-level statin, and an ACE inhibitor. My monthly medical costs, if I was not in the service health plan, would be over $2,000 a month. Something to think about when he said, make that calculation, see how it affects you. I do have a couple of tax tips or tax items that I want you to think about. If you have inherited an IRA from a spouse, from your uncle, from your grandfather, make sure that you've had it properly transferred and set up your own beneficiaries. People sometimes forget to do that. If you're doing a rollover of money from your 403B or a similar plan to an IRA, get it done no later than Thanksgiving. It takes time to process, then you get into the holidays, and some people have, if you file on Christmas Day and want to transfer money over to take advantage of the 22% tax rate, some of those won't get processed. No later than Thanksgiving, you should probably turn it over. Come New Year's, one of the things you need to do, this is both for your SURS and your 403B money, and your IRA, if you've got them, or your annuities. Take a look at the beneficiary forms. Is your former spouse on there? You got somebody who passed away, was there as a beneficiary? You should look at that. Make sure you always have contingent beneficiaries. Okay, my wife is my beneficiary. I have 3 adult children on part of what will be my estate. They are the beneficiaries, but also all of my 403B money will go in trust for my 5 grandchildren, bypassing their parents. And we made the kids equal, because otherwise the family that has 2 kids eventually would inherit more per person than the family with 3 kids. Something to think about. When you get your year-end statements, particularly if you've got an IRA or a 403B, make sure that the information is correct and consistent with the data that you've got from the rest of the year. For those of you who are 70 and a half or older, you're going to have to start taking your required minimum distribution unless you have a Roth. You also have, until the filing deadline of April 15th, you can still put money into a 403B that would be in part of your 2018 tax year. And if you've got the money sitting around, you can make your IRA contributions early. The major thing is that if you're making a contribution, you have to do it from earned income. You can't just transfer willy-nilly, although you can convert out of a 403B.
Well, thank you. Well, thank you for all, to all the three speakers. We passed the cards out, and I have some, and some are still being picked up. I'm going to give the mic to you. So, randomly shuffling to choose the first one. This is probably for Lee. Can we buy service time? Any other buyouts coming? Money for service time, etc. How often do the actuarials change?
Okay. All right, so as far as ways or means to increase your pension benefit, there are what we call service credit purchase options. Basically, if you have a pool of money somewhere and you just want to give it to SERS, you can't do that. But if you have some type of qualifying service credit where you've worked at another public university or you've worked at another public school in the U.S. that's full-time, or you've been in our system, elected a refund and returned to the system for at least 2 years, those are opportunities that allow you to bring service back into the system or reestablish new service. What I'd suggest, if you've been at the university or any of us SERS-covered institutions, contact our office, discuss with our call center your employment dates. We will request information from the employer and we'll kind of get things processed. If you've been out of state, so if I worked a couple of years in Tennessee and in a school system or school district or any K through 12 or university that's public, and I've taken a refund of contributions and I did not vest. So I was there, say, a couple of years, left the system, took my money out, knew I was never going back to Tennessee. That's time that can be purchased within this system as long as I've been in SERS for at least 5 years. I've met the minimum vesting requirements. That's what we call other public employment. And the refunds are basically, I left the system and never coming back, and then you find yourself back. So, as far as the actuarial calculations and those changing, to give you a framework, there are a number of formulas we use to establish your pension benefit. We will always calculate all applicable formulas. For about 40% of us, the highest formula is what we call the money purchase formula. Now, you don't have to really know the formula, you don't have to know the names. Basically, the highest benefit is what we pay you. So it's not as if you have to make an election. However, the money purchase formula really is based on two components, simply. When you're sitting with faculty and deans, you want to say simply all the time. The two components, the assets in the account and your age. So we take the pool of assets, we divide it out based on life expectancy, and we come up with a monthly payment for your lifetime with the automatic annual increases. By law, every 3 years we have to review and revise those life expectancy factors. Our actuary goes out, looks at our life expectancy experience, comes back to us and tells us that, unlike you hear in popular media, people living longer, people aren't living longer, we are living longer. So every time we've revised life expectancy factors, because we are living longer and the amount within your account is fixed, we have to take a fixed amount of money, make it last longer, which means we pay you less. July 2nd of 2019, there'll be an actuarial reevaluation. New money purchase factors will be implemented. Our pensions under that formula will be reduced between 5 and 6%. Every 3 years, this will occur. Now, previous years, the state was very, there are many different dates that we've implemented this money purchase factor change, but moving forward, the likelihood is it'll be July of every 3 years. So
You're already answering some of the questions that are on the cards here.
well, good. I'm moving ahead. So for those who aren't retiring next year but looking toward sometime in the next few years, keep in mind that July of 2022, you'll probably see another one of those actuarial changes.
Okay. Several questions are on Tier 2, and I know some people here are already retired, but some are still working. And so Tier 2 is a newer program, and we're pleased you're here, and we're happy to have these questions. General ones, can you explain more about Tier 2? How significant is Tier 2 in lowering the deficit in Illinois? Is this change due to budget issues in Illinois? And we've paid in 8% contributions. Are we getting out what we deserve? Those are several Tier 2 type questions. I think our business dean gets this one.
Well, I'll start. Tier 2 was absolutely done entirely because of the state's fiscal situation. So recall that I said that the legislature under the Constitution is unable to change benefits for people already in the system. So therefore, they just gutted the system for those that hadn't yet joined. So anybody that started January 1st of 2011 or after is under Tier 2. I'll defer to you on all the details because they're not fresh in my mind at the moment, but it's much longer vesting periods. It's got a lot of features in it that do generate a lower benefit for the traditional and for the portable plan. The self-managed was sort of left alone. How significant is it in the short run? Well, for the state's finances, in the short run, not all that significant. If you look out, 40 years, by the time that essentially everyone still in the system is on the much less generous Tier 2 system, it doesn't mean that everything will be fine because our hole is pretty deep, but it'll be a lot less bad than it would have been had we stuck with Tier 1. I don't know if you want to speak to any of the specifics of the benefit changes.
Yeah, as far as the provisions of the plan, the basic provisions are that you, for the traditional and portable plans, the basic vesting is 10 years. The benefit payment begins as early as age 62, but that's considered early retirement. Normal age is 67. Those are the basic provisions, and we'll leave it at that.
Let me just say real quick, as a dean that hires lots of new PhDs as new faculty, and you come in and you have a 6-year tenure clock, and even if you have family leave and so forth, you're typically going to come up for tenure in 7 or 8 years. The notion that you would come into a system and choose a plan that has a 10-year vesting schedule when you're not participating in Social Security over that time period, it's a horrible setup and a horrible decision to give somebody, which is why more and more new people, if they're coming in, are choosing the self-managed plan, even though the self-managed plan is far less generous than in expectation than either the Tier 1 or the Tier 2. So it's, our state has tied itself in some knots, and every time we take a step to try to do something about the cost, we further complicate the system, we further complicate the choices that individuals make, and of course, if it's saving money, as I said before, somebody's being made worse off by it.
Okay, keep that. Several on health insurance. Some are straightforward. When I retire, what kind of health insurance will I get? Can I keep my UIC doctors even if I live somewhere else? Please explain again the provisions to opt out of health insurance with the those promises to pay, and so forth. So several on health insurance, and I know this for people coming up, it's what age you are and whether you have Medicare and so on. That's probably Lee.
Right. So for those who are not Medicare eligible, upon retirement, if you've met the basic vesting requirement, then you do have to be in receipt of the monthly annuity. So you begin receiving the pension, you're able to participate in the health insurance program. If you have less than 20 years, there's a portion of the premium that you will have to pay. So the state came up with this cost-sharing mechanism. The euphemisms are there. So keep in mind, whenever you hear a euphemism, having a little alarm go off. State pays 5% of the premium for each year of service credit you have. So if I have 15 years of service credit, they pay 75% of the premium. Now, if I'm not Medicare eligible, I have the same options I have now. Quality Care, HMO Illinois, all of those options are available. Once you're Medicare eligible and you are retired, the second year after Medicare eligibility, you shift to the TRAIL program, another acronym. TRAIL is the Medicare Advantage program sponsored by the state. The good news is the premiums are, it's very cost effective. It's more cost effective than anything you can find in the real world. You continue to have the health insurance, the life insurance, which is reduced to $5,000. Dental and vision are still a part of the program, so that continues pre-Medicare eligibility or post-Medicare eligibility. It's just that with the Medicare Advantage program, you are limited to United Healthcare is the PPO, and Humana and a couple of other providers are the HMOs. So, and you are notified of the Medicare Advantage enrollment, the TRAIL program, so you'll receive information and you'll have time to make those elections. Oh, and as far as the opt-out incentive, if you visit the CSRS website or the Central Management Services website, you can get more information on the opt-out incentive. But again, the basic provisions are for anyone who is an annuitant less than Medicare eligible age, so age 65, well, earlier than age 65. If you have coverage that is qualifying or meeting certain standards, you can opt out of the state of Illinois health insurance program. The state will pay you $150 per month if you have less than 20 years of service, $500 per month if you have 20 years or more. That is payable again on a monthly basis until age 65 or until you elect to re-enroll in the plan. Any qualifying event allows you to re-enroll. So you're not opting out forever, just for basically for the plan year or until a qualifying event occurs.
A question about amending the pension language for the Constitution, which could be in 2020. When and how would those changes take effect, and who would be affected?
Well, I'll reiterate, I think it's highly unlikely. It would either, I mean, it's laid out in the Constitution what's required to amend the Constitution of the state of Illinois. This would require an amendment to the Constitution to change the non-impairment clause. So you can either do this through a constitutional convention, which is how the non-impairment clause came about originally back in the early 1970s. Although I will tell you, I haven't verified this fact, so maybe I shouldn't state it, but someone told me that if you look at the composition of delegates to state constitutional conventions, they're very heavily dominated by retirees and by union representatives and so forth. And so I think it's actually not super likely that a convention would lead to that change. So I actually am not predicting that will happen. And if it were to happen, then it would be up to the amendment folks at the time to determine when it would take effect. But it could only take effect sort of on a going forward basis. I don't believe that you can, even with a constitutional amendment, I don't believe that you can go back and sort of retroactively take benefits away from folks. That's to the best of my understanding.
Here's a Social Security question, so probably John. Drawing Social Security at 66 without retiring from UIC, is Social Security draw impacted by my non-wages or pension expectations? And once I begin to draw Social Security without retiring, what happens to the new income index rate impact on Social Security? You probably understand the question better than I do.
Basically, Social Security is taxable if you have sufficient income. Your SURS pension.
Federal tax, not state tax.
Federal tax, yes. Can you repeat the question?
Hey, I've lost the card. It's a long one.
Once you've reached your full retirement age, be that 66 or 66 and 2 months or 66 and 4 months, depending on what year you're born, you no longer have an income offset. If you took your retirement at age 65 and took Social Security before your full retirement age, anything over, it's about $15,000 a year, you would lose 50 cents of every dollar that you earn above that level. But as soon as you become full retirement age, that disappears and you'll get your full benefit without any takeout. You can work post your full retirement age, and you collect your full amount of Social Security plus whatever salary you're earning.
Yeah.
I just want to add one piece to that. So back to saving for the future. For those who have reached their full retirement age in Social Security, plan is continue to work at the university. They are not in receipt of their pension. Typically, the Social Security, because of the windfall elimination provisions and the governmental pension offset, will be reduced eventually, so you might as well get what you can when you reach your full retirement age. And my suggestion is try to put that away into one of those voluntary plans here. So basically, if you have $1,000 coming in from Social Security, reduce your income here into one of those tax sheltered programs. By that same $1,000, it kind of makes it go away from a tax standpoint and puts it away for your future.
So, Linda, I'm putting you on alert for this next question, because I want some SUAA comments as well. Is Tier 2 in violation of the Safe Harbor Act? And then I'm going to add, if it isn't, it's not legal, what might SUAA do to challenge this? When might court cases be heard?
Let me first comment on the Social Security thing, and then I'll come to this, although we might pull Linda up. For anyone that's thinking of taking Social Security before your normal retirement age, he spoke about the earnings test and how they reduce your income 50 cents on the dollar. I think it's important to know that you get that money back later in the form of higher benefits after the normal retirement age. So it's not a tax. It's a retiming of the income, and that's broadly misunderstood by the general public, but don't think of it as a pure tax. On the issue of Tier 2, so what do we mean by the safe harbor? In order for a state to be permitted to provide a pension system that excludes its folks from Social Security, the pension has to meet some minimum thresholds in terms of its generosity. Now, the way the rule was actually written is that you have to get at least as much money out of the public pension as you would have gotten had you been in Social Security. But that's a complicated calculation to go through and do for each individual. So Congress specified some safe harbor provisions that basically look at the plan parameters, whether it's in the defined benefit system, it's based on the multiplier times the years of service and how generous that is. If it's a defined contribution plan, they look at contribution rates. And what they've done is they've specified that as long as you've got factors that are at least this amount, then your plan qualifies. I believe that the Tier 2 qualifies under those safe harbor provisions, even if at an individual level there might be some individuals that are made worse off. So as long as they meet those safe harbors, and I believe they do, and Linda's shaking her head yes, you're welcome to take the microphone.
Can you get the microphone? So for those of you who don't know, Linda Brookhart is the executive director for a downstate office in Springfield.
I think what Jeff just said was it becomes an individual basis because right now, I sat in a year or so ago, I sat in a hearing, the state legislature, it was in the House, and someone was supposed to come in and talk about the safe harbor. But after sitting there for an hour and nobody had addressed it, they were addressing everything else, come to find out that there had not been a determination on that yet. And probably the federal government would not make that determination until those people who had been vested for 10 years started retiring. So we're kind of twixt in between. There could be that they are under safe harbor, or they reach the safe harbor. There could be incidents where maybe they don't reach the safe harbor. There's very few people that only work 10 years and retire. So this is kind of an ongoing thing. I think, what is it, 2022 is before we'll actually know the right answer because of when it went into effect. So we've got another couple of years to go, or at least that is our understanding. The other thing is if we would have to challenge legally, of course we would, but you know, the most what would happen is the state would have to repay those in Tier 2. I say that most try to get money out of the state.
Thank you. I have to comment, obviously going to have more questions here than we can answer. Many of them are quite specific to individuals, and so I've set them aside. For those people who have those questions, you can get the answers from your SUAA's person, and that's a better way to do it because there isn't a one answer that works for everybody. Things about the age of the spouse or how many years you worked somewhere else, or, I mean, obviously things like families, health, and so on. It's not that I don't care about those questions, I do, but you're better served by reaching out to your person, right, Lee? Yes. Okay. For Tier 1, for how many years of work are you vested, and when do you qualify for insurance cover with retirement? And perhaps do that for Tier 2 as well.
Okay, so the basic vesting requirement for Tier 1 employees is 5 years. So if I have 5 years within SURS, at age 62, I can begin receiving a monthly payment. If I have 8 years of service credit within SURS, I can begin receiving a monthly payment at 55. And if I have 30 years of service, I can retire at any age without penalty. Doesn't mean that I'm at the maximum benefit payable, but it does mean that I'll receive at least 66% of my final average salary as a monthly payment for the rest of my life. Tier 2, portable and traditional plans, the vesting requirement is 10 years across portable and traditional, and the ages are age 62 for early and age 67 for normal. Now, the main thing to keep in mind with the portable plan in Tier 2 is that while we strive to reach the 10 years of vesting, if you don't make that, if you do make at least 5 years and you've chosen the portable plan, you can elect to receive a lump sum and you receive matching contributions. So the ideal is probably not to take money out of the retirement system, and I tend not to suggest that, but in Tier 2, if you don't meet the 10-year standard, you can't receive a monthly benefit in the portable or traditional plans. The only real option is to elect the lump sum, and that in the portable plan, if you've met 5 years of service credit, provides a dollar-for-dollar match. Now, at the time you leave the system, let's say I have the 5 years of service credit, I leave SURS, I'm in the portable plan, there is no obligation for you to take the money. Now, inherently, we tend to want to, but the bottom line is I always say, go get settled in the next job, then come back and evaluate your options. In portable, we're paying 6 3/4% interest. Our Board of Trustees sets that rate of interest each year. Pretty good rate of interest for you not having to make any elections. In the traditional plan, the rate of interest, we say it's 6 3/4%, but if you take a lump sum, there's a penalty, it's 4.5%. But 4.5% is still better than what you can get anywhere else. So with both plans, if you don't meet the standards of vesting, you always have the option of just keeping this as a savings account, and you can always elect to receive it sometime down the road. It'll never be quick money. It's always going to take at least 60 to 90 days for us to pay it out.
Well, we're almost at the end, and I've got so many good questions left. This is challenging. But this is one that comes up a lot, and I know it was covered earlier, but please explain the windfall calculation again.
The reason the government does the windfall elimination process is because of this 90%, which is the social part of the Social Security. What happened some years back, people would work for the government for 5 or 10 years for the federal government. And then they'd leave the government and have a small government pension, go to work in industry or for a nonprofit and get enough quarters in to get Social Security. But given that they probably had additional money, the decision was made to, if you have 20 years or less of coverage in Social Security, it drops the 90% down to 40%. But for each year beyond 20, it basically increases about 4%. And so in my case, I had 30 years, and I've got some charts that shows you how many years you get and what the percentage is, but it goes from 40 to 44 to 48 to 54, and it gradually increases to 30. If you've got 30 years, there is no windfall elimination. If you have further questions, see me after.
I think that probably applies to many of these here. So our time is up. I'm not going to ask you, are you a member of SUAA? But secretly, if you're not, and you found this event useful and the other events we have, please do pick up or if you were not already given, a membership form. It's less than $4 a month. If you're a current employee, it can be payroll deducted. And I think it's then something like, somehow it gets cheaper for billing reasons. It's at, I think ours is $1.80 for 2 weeks, something like that. So if you're not joining, please, we need those little bits of money to support our Springfield office and our chapter, and to put on these events for you. So it's very little. Feel that common good, and please join. And I want again to thank our panelists for a very interesting morning. Thank you.